Welcome to the Nuts and Bolts of Real Estate. My name is Joe Bauer, and I'm here with my co-host Julie Clark. Julie, how you doing today?
All good in the hood over here today, Joe. Just doing my thing and excited to. It is January 2023. So, unfortunately, it is that month where I feel like I just bleed money, right? You got to book all your vacations. You got to make sure that you're paying your taxes if you maybe you've paid quarterly, but that's an ouchie. All the camps, all the school stuff. It's just a month of pure spending money like a sailor. So got to keep the energy up to have a kick-ass year here in 2023. And for some of you, that might mean that you're ready to trade up. So I'm going to jump right into it today with what our topic is. Although maybe first I'll ask Joe how you're doing.
Doing well. Yeah, doing really well.
No
Not
news on
not
the van.
no, still trying to find a buyer. No news on the van, but
Man, it's like having a house on the market for too long, right?
I
Got the van
think
on.
I think the van market follows the real estate market a little bit right now,
I
unfortunately.
guess so. All right, well, let's go help you guys out and how you can keep some of that hard-earned money that you've been working on. As we all know, one of the best parts of owning real estate is that you can either force appreciation by maybe repositioning the asset or the property through like a value add strategy, or if you've owned property for a long time, which is what you should be doing in real estate, likely you've benefited from tremendous appreciation due to maybe increasing rents over the term of your ownership. Sounds great, right? But what happens when you want to like sell that asset and you want to trade up? Maybe you want to trade up, or maybe you just want to cash out because you're tired of being a landlord. You've grown your wealth over all these years and you're ready to just cash in and relax. Well, then comes the old capital gains tax, which a lot of times can probably hold people back even from selling. Because trying to find a suitable 1031 sounds like a full-time job to me. I know when I think about it, when I think about selling some of the assets, I'm like, God, I'm gonna have to quit my job for a lot, just focus on trying to find a property to buy or something like that for that exchange. So we want to know, what are the alternatives? And that is what we are going to talk about today. And we're going to cover today with Mr. Brett Swarts, who is the founder at Capital Gains Tax Solutions. So welcome to the show, Brett.
Julie and Joe, it's great to be here. Thanks so much for having me.
Awesome stuff. Well, we're going to let Joe kick us off so maybe we can get to know you a little bit better.
Heck yeah, Brett. So our first question is always pretty much jumping back in the time machine and learning about you more. So, like how you grew up, where you grew up, all that stuff, and then how it led you to where you are today, and as much or as little of that as you want to share, because we want to get to know you better.
Yeah, I fell in love with real estate at a young age in the Bay Area of California, Mission, San Jose, Fremont, Silicon Valley, Alameda. My mom and dad building houses and owning rentals. You know, the sticks and bricks, the Bobcat, digging holes, moving bricks, hammering nails. It was a fun time. My brother and I, he's kind of a kid's dream. You get to go spend long days working hard. You get up early and you have your lunch ready to go, and you go and you learn how to build real estate, which is really cool. Build things in real life. Fast forward, I had a chance to study and practice multifamily brokerage at a place called Marcus and Millichap, which is a commercial real estate firm, and learn from some of the best in the business, some really smart people who taught me negotiation, underwriting, IRRs, cap rates, 1031 exchanges, and things were going well for a little while. And this is 2006 when I was still in college, about to graduate, but I was at Marcus and Millichap, and momentum was picking up, and the market was really good. And then all of a sudden it wasn't, and it went from making a little bit of money to like nothing overnight. And I remember sitting with my wife at a place called Cheesecake Factory on a random Saturday. And this is somewhere around, I don't know, I think it was 2009 at this point. And we've been struggling for a while. And it's like, what are we going to do here? Like, we got to go get like a real job. And a real job meaning salary and benefits and all of those kind of things. We had a new baby on the way, and I think did what every good entrepreneur or real estate wannabe does. You get a side hustle, and that side hustle became Cheesecake Factory. I started to work nights and weekends at the restaurant, and by day I'd make cold calls and negotiate with banks and help my clients hold the properties and reposition them and rent them out and different things like that. But it was 100% commission, so I had to get the cheesecake to keep the lights on, and we moved with my brother to a small condo, and we did that for 2 years. So I always share with people that's the beginning, right? It was a time it was scary for finances. It was scary for the dream, but I felt I was in the right spot because I was learning a lot. And during this time period, I learned from a gentleman who spoke about something that would forever kind of change the trajectory of my business and how I help people, but really change the clients that we serve today. You see, while I was going through my financial struggle, maybe on a smaller scale, some of my clients were losing half or everything, and they had multiple millions of dollars. One client in particular had $50 million worth of multifamily real estate. He was pretty leveraged. He lost all of it in the next, from 2008 to 2011, lost everything, went bankrupt, lost his marriage. He was probably worth, I don't know, at least 10 to $15 million, but his real estate was worth 50. And the reason we found was because of the 1031 exchange. You see, he had overpaid, he had over leveraged, and he had too much debt and not enough liquidity. And that's where we said there's got to be a better way than just having to chase deals via the 1031 exchange. Everyone loves to be a seller when the prices are high, but they hate to be a buyer when they're in that 1031 exchange. So we learned about the deferred sales trust, which we're going to talk about, and things started to change from there. Started to meet and solve problems on a way that most people were solving blockbuster problems, and we were providing Netflix. And fast forward, now I coach and train, and we close about a deal a week. But I work with top high net worth individuals and their business professionals that they work with, CPAs, financial advisors, commercial real estate operators, to help them map out a transformational exit plan, not using a 1031 exchange, not using Blockbuster, using what we would refer to as a Netflix exit plan. So that's the story, and that's a little bit of the background.
Awesome stuff. I can't wait to hear that analogy, the Netflix and Blockbuster strategy. So let's back it up for a minute. So what is the difference between a 1031? What are the alternatives? Let's say we have a 1031, we have, which most people know what that is, you're listening. We have something called a Delaware statutory trust, which is not what we're talking about today. And we have what? The deferred sales trust, right?
Yeah, those are three. You can do a traditional 1031 exchange. You can do a Delaware 1031, also known as a Delaware statutory trust. You can also do cost segregation to offset capital gains tax by accelerating the depreciation on such as multifamily assets. You might do an opportunity zone, if you can hold the capital or illiquid for a long time. You might give it away to charity. So there's definitely some options. The question is, Julie and Joe, is what are you trying to do? And that's the first question we're asking our clients. Hey, your A is where you're at and B is where you want to be. And what are your goals and ambitions? And what are your desires? What are your challenges and your problems? Why are you selling in the first place? What's your motivation to sell? Why not just hold on to the property? Why not just refinance and go buy it somewhere else? If you refinance, you don't have to sell and you don't have to pay capital gains tax on a refinance. So there's all these different reasons why someone might sell. Okay. We're entering into one of the largest wealth transfers in the history of the planet right now. Just the sheer demographics are pretty astounding. And there's a stat that I think is really interesting. And it's according to the American Bankers Association. They found that there's about 77 million baby boomers in the US alone. And every day they're turning 65. And a number of other studies showed there's going to be about $30+ trillion that's going to transfer from the baby boomers to the millennials in the next 18 to 20 years. And this is known as the largest wealth transfer in the history of the planet. And there's a number of reasons these baby boomers want to sell. It could be health. It could be time and energy. It could be a retirement. It could be starting a new business venture. It could be ending a partnership. It could be death. It could be divorce. It could be a number of things that make and increase the motivation for someone to sell. So then the question becomes, what's a good plan? And who are the good team members to help them execute what they're trying to do? And too often we've been taught that the 1031 exchange Blockbuster is the only way, that you swap until you drop and you get a stepped up basis, and that's the end all be all. And there's a lot of people that don't want to deal with the toilets trash, the liability, the illiquidity, the rising interest rates, the ever increasing government regulation on a number of states such as California. It's a nightmare to own real estate for a lot of my clients compared to what it was, 10, 15, 20 years ago. And people are saying, why am I doing this if I can still have tax deferral? Oftentimes we increase people's cash flow by 60% on average, and no more risk in the sense of you're not tied to your property as far as that risk. The investments are subject to risk, so there's always risk there, but you can diversify. And that's the beauty of what we do with the deferred sales trust. We can diversify your equity into multiple different cash flowing machines. different investment classes, dollar cost average. And I mean, it's 2023 now, right? There's got to be a better way than the 1031 blockbuster. And there is. And this is what we're here to help people unlock for themselves and their families.
Absolutely. So we run into people that they're landlords, they're either tired landlords, or maybe they want to trade up, or they're just done and they don't want to own property anymore. And so let's dive a little bit deeper into exactly the differences. So with a 1031, you have a limited amount of time, you got to buy a property, you're kind of under the gun. Give us the Netflix blockbuster. I like that analogy. I've heard you say that before.
Yeah, so our parents taught us to sell high, Julie, and buy low. Sell high and buy low. It's pretty simple, right? But Joe, they didn't teach us to sell high and buy higher 180 days later, right? With rising interest rates and cap rates that are still pretty flat, with an influx in negative arbitrage, you're borrowing more than your cap rate. Now, not good. You want to get a higher cap rate and a lower interest rate. But that has flipped over in the last 12 months. And it's not a good idea to 1031, to be honest. That's what we believe right now. Unless you can find a deal that has forced appreciation, that you're going to buy the deal on its intrinsic value, on its cash flow that it has today, and the ability to increase the rents or improve the property to sell for a gain. If you have that, by all means, do a 1031. It's cheaper, it's less complex, and it can certainly fill that what you're trying to do. We still do 1031s with clients. It's just very rare right now because I'm a broker as well, multifamily broker. Most of what we're doing is the deferred sales trust. But that being said, why do the deferred sales trust? Well, you can sell high and buy low. That's the number one reason, and that might be the only reason you need. And I'll give you a deal story for this. In fact, it's the reason I started my company, to spread this message. In 2006, a gentleman sold a property for $20 million in Minnesota. And for the first time, he didn't do a 1031. He sat the funds into the deferred sales trust. And the deferred sales trust, by the way, in case you're wondering, is an installment sale where you're owed back the money. You get paid slowly over time, but the funds can be put into a bank. They can put it into stocks, bonds, and mutual funds, which is not an exciting thing for us as commercial real estate people or real estate people, but there's a time to sell and there's a time to buy. There's a time to be in real estate and there's a time to get out, right? There's a time for everything in every season of life. And for him, he was diversified and he was protected and hedged. So he wasn't subject to the huge crash. In fact, he was happy just to get even at that point because he said, you know what? This 1031 market doesn't make sense right now. I'm either going to pay the tax or I'm going to do this deferred sales trust. So fast forward, he did the deferred sales trust. His money is sitting pretty even during the 2008 crash of the stock market and all of that. And 5 years later, from the time he sold, his property was foreclosed on from the other buyer, was foreclosed on by the bank. And the bank calls him up and says, hey, do you want to buy your property back? You mean the one I sold 5 years ago? Yeah. Well, maybe what's the price? And he said, well, about 60 cents on the dollar. He said, that sounds pretty good. Give me a couple of days. He was able to have the funds in the trust, partner with him to buy this property back at 60 cents on the dollar, not paying a dime of tax on this. They're still in a tax deferral state, not using a 1031 exchange. Obviously, it's 5 years later. It's past the 180 days. And this is the part where my brain started to explode. Like, this is Netflix. This is what we were waiting for. Why isn't everybody doing it? What we thought we were the Navy SEALs of investment real estate, multifamily brokerage, 1031 exchanges. And all of a sudden, they're telling us something that sounds like it's like magic and it's too good to be true. And that began the journey of, is this thing legal? This thing can work? How many of these have been done? Has the IRS audited them? What really can happen? Does this work for cryptocurrency and primary homes and business sales, not just investment real estate? And all of these questions started to just, and as you answer these questions and understand how it works, you're like, oh, this is Netflix. I'll never go back to Blockbuster, right? And that's what we find is once we have a chance to spend some time with you, your business professionals, we walk through the track record of thousands of closes, billions under management, over 20 no change audits, perfect track record. Now it takes a team to execute it in a certain order. You got to make sure you have all of everything lined up properly. It becomes a home run, and people's lives are transformed. You unlock freedoms that you didn't think were possible. No more 1031, No more, you can actually rescue and save a 1031. No more buying high during a 1031. No more taking on a ton of debt that you don't want to take on. Oftentimes increasing cash flow because you're able to diversify and dollar cost average and get into different things. So many things that we're here and we're trying to make believers out of everybody, including everyone listening to this podcast right now.
And so when I'm thinking, I'm trying to like reverse and dumb it down a little bit here. We run into a lot of people that they don't want to take a capital gains tax hit. Maybe they own an apartment building. I just sold a 7-unit myself here in West Seattle, and I was trying so hard to get this elderly lady to do some sort of seller financing instead of just take her tax hit. She had a terrible, terrible tax professional on her team. I didn't know you at that time, unfortunately, but some sellers go straight to, well, I guess I'll just, maybe an option is to do a seller financed sale, right? Where they just take a down payment and they carry the note, right? That's a form of seller financing and deferring your capital gains tax over time. But the difference is you're not actually getting to redeploy your proceeds. You are stuck owning the property, not owning, but your asset is tied to, you're tied to that asset you just sold. So for the people listening, let's back it up for a second and explain the difference between a traditional seller financed tax deferral strategy versus a deferred sales trust. Wouldn't you agree that's a good back it up?
Great place to start. Thank you, Julie, for sharing that. Hey, do you remember the Hollywood Videos down the street from the Blockbusters?
Oh, yeah.
Well, Hollywood Videos were the competitor, if you will, or the local family video store. They've been around forever. Everyone actually kind of knows them, right? That's the traditional installment sale. Every CPA knows them. Just about every real estate investor, they actually know them even better than 1031s, most people, right?
Right.
Whereas a seller, you can carry paper. You can become the bank. And what you haven't received, it's in a tax deferred state. It's based upon IRC 453, which is an installment sale, which goes back to about the 1920s and 30s. Okay, it precedes the 1031. That is the foundation of the deferred sales trust. So you see why I say Netflix versus family video store, because they're both achieving tax deferral, but we're going to give a lot more freedom and flexibility. Instead of having to return it within 3 days, you have to rewind it. It may or may not be checked out. You got to drive in the snow or whatever in the heat to go get this movie. Netflix came out and changed the game. Well, that's what the deferred sales trust does. Instead of financing a buyer who, by the way, is probably not investment grade, may or may not pay you back, may or may not run your property into the ground. You may or may not have to foreclose on that individual. Take the asset back that you just sold. That's just when you think you're like 3 years out of it and you're like, oh man, this feels so good. The whole thing falls apart and now you're having to start all the way back over and pick up the pieces. So that is the family video traditional installment sale, or Hollywood video.
Which is
whereas the
interesting.
deferred sales trust, we're going to finance the trust. We're actually going to ask that buyer to show up with cash or go get a loan. We don't care how he shows up with that deal. And let's just give you an actual deal. A client of mine, he had 18 units in South Sacramento. Okay. He lives in Marin County, Marin, California. He's driving 2 or 3 hours. He's fighting that traffic. He's 70 years old, 2 days a week. He's just grinding. He's knocking on doors. He's trying to hire property management. He's in a tough part of South Sacramento, by the way. South Sacramento can be a little bit rough. And this is a drive-by shooting. His car gets shot. Not that he was in the car. He was fortunately with one of his tenants. But this is the reality of this multimillionaire spending his time and energy away from his family, going into harm's way, trying to figure this whole thing out. And he's feeling trapped by the 1031. And I sit down with Peter and I say, Peter, why not just do a Delaware? Why not just do a 1031? Why don't you do a regular 1031 exchange? He goes, Brett, here's why. I have 18 problems. I don't need 36 problems. I got 18. I want to be done with this. I've made and he's, $3 to $5 million. He's like, I made the millions. I don't need any more. I'm 70 years old. I want to spend time with my family. The deferred sales trust is perfect for me because I can defer the tax. I can get diversification. I can get out of debt. The other thing about the 1031 is you have to replace the debt, right? So for him, he said, I don't want to have to potentially carry paper for a buyer to have the nightmare to think about, do I have to foreclose and take that property back? I'll let the buyer come with his own capital. I might even take a little bit less of a price. I'll sell it. I'll defer the tax using the trust, and we'll ask the buyer to cooperate with the trust. We do this up front, and we're brokers, and we work with companies and groups across the country to structure it properly. And at the close of escrow, the smoke clears. The buyer takes title. The trust itself bought it from the seller, in this scenario, Peter, right before it sold it to the ultimate buyer. So it's like a simultaneous close. And the trust establishes a new basis. So this particular sale, about 1.9 million. Okay. He had some debt on it of about 500,000. And so about 1.314 went into the trust as a promissory, and then he got a promissory note for that amount. The rest of it paid off the debt, paid the closing costs, and the buyer took title and he's gone. But forever, the money is not tied to that old buyer, that old property. It's truly freedom from your old property. He's out of debt. He is tax deferred. And guess what? He's been waiting to pounce. It's been a few years since he did this deal. He showed his whole deal on my YouTube channel. You can go there and check it out. But we're waiting for opportunities. We do believe in the next 12, 24 months in Taxifornia, for people who overpaid for properties and other places around the country too, there's going to be opportunities to buy at a discount. And that's when we're going to strike. And that's the exciting part about this.
Yeah. How does that work in regards to, is there a reasonable is he paid monthly, like an installment sale, like you establish a reasonable payment? You get what I mean?
You got it, Julie. Yeah, exactly. It's based upon their needs and wants. Sometimes some of our clients delay it for a year, maybe two, and let the interest just accrue and build up, which is a nice strategy, especially if you're moving out of state. We did that for a client out of Palo Alto. He sold a primary home for $8 million, established residency in Nevada, and started to take payments off of the trust once he's in Nevada. And since he's in Nevada, he gets the income tax rate based upon Nevada, not California, which is pretty cool. And the payments can be monthly, it could be quarterly, it could be annually. And yeah, exactly what it is. There's a payment schedule, such a payment. Go ahead.
Are they the same payment? Is it or it can be whatever? It's kind of like a draw.
Good question. So it's typically the same payment. Like, let's say it's 10,000 a month every month, right? First of the month, or 10,000 a quarter every quarter. It's typically the same. The question is, can it be adjusted? And the answer is, yeah, it can be adjusted along the way. And and some clients, like I had a client, we just did a $17 million deal in Sacramento for a billboard sale. And he wanted $400,000 up front just to be able to spend on whatever he wants. Now he'll get taxed on that. That's his money. So instead of putting all the money into the trust, he paid off some debt, paid some closing costs, took a $400,000 distribution, and he's paying tax on that. And then he's delaying the other distributions until next year. And so there's ways that we can structure and customize it based upon your needs, Julie, if that makes sense.
Hey guys, it's Julie here with a quick break from the show to discuss an opportunity some of you may have interest in, which is to work more closely with me. On almost a daily basis, I get calls from investors and brokers, both new and experienced, asking me for guidance or advice. I love helping you guys out, and it keeps me on my toes too. So with that said, I wanted to let you know that I have a private broker coaching community called the VIP Education Community. And the best part is that it's 100% free. That's right, it's free to join. So whether you're a traditional broker or a broker investor, my VIP education community offers personalized one-on-one coaching from not just me, but also from my experienced broker friends with expertise in all disciplines of real estate and real estate investing. We'll teach and share our modern marketing strategies, our tech and lead generation resources, plus teach you how to identify or offer up opportunities for yourself or for your clients using techniques such as seller financing, lease options, land entitlement deals, BRRRR investing, flipping, multifamily or commercial coaching, whatever you like. We've got it all covered for you. The future of real estate is changing fast, and to stay in the game, it's time to learn about all the options you can offer your buyer and seller clients, as well as, if you want, learn how to use those skills to grow your own real estate portfolio. If you'd like more details about joining my VIP education community, reach out to me at julie@seattleinvestorsclub.com or text me at 206-910-2985 or just send me a Facebook message. My new favorite phrase is community equals confidence. So let's navigate the future of real estate together. Now, back to the show.
It sounds like when you have checkbook control over your retirement account, except for instead of putting money in and taking control of it like you do with your retirement account, it's you've sold something and you have full checkbook control, right? Is that, I mean, essentially it? Or
Let's talk about the downsides that someone might say, like, why wouldn't I do this? So you have what's called indirect control. Okay. Which means what? Well, you got to work with the trustee. Who's that? That's me. Third party, unrelated trustee. Capital Gains Tax Solutions is a trustee company. And we provide that service for our clients or anyone who wants to use the deferred sales trust. We're kind of like a qualified intermediary. If you think about it, you give up control when you send the funds over there for a period of time, right? Indirect control. The funds can't stay in your hands or touch your personal account because it's taxable. So we have a qualified intermediary. We have deferred sales trust. We use biggest banks in the world, TD Ameritrade, Charles Schwab. Other financial advisors have huge banks or just big commercial banks to hold the funds. So it's all protected. Third party, you have access to do the funds online. Nothing moves without your signature or approval. But it also doesn't move without my signature or my approval. So we have this dual protection going on, right? But you have to give up some control, because if you have what's called unilateral control, Julie, then it becomes taxable. So this is part of our role, is to help guide you through so it doesn't become taxable and perform that service. But that being said, some people can structure notes at 10-year notes, 5-year notes, 4, 3, 2, 1. Like if you want to know that all my money's coming back in a short period of time on a balloon payment, you can do that. And then you can always refinance and go down and just keep it going. But most of our notes are set up as 10-year notes, paying somewhere between 5 and 8%. Compounding. If you're completely passive, if you're active, you can make more than that if you partner with the trust. And that's what a lot of our entrepreneurial clients like to do. So don't think of this as just like completely passive retirement, go to sleep kind of thing. You can do that. You can be completely passive and retired and receive sleepy, cash flow where you don't have to do anything for it. Or you can partner with the trust and be an active entrepreneur, which is our favorite part. We had a client who sold a $2.6 million business in Alabama, partner with his trust to build 70 multifamily units in Tennessee, because that was his entrepreneurial freedom. He wanted to separate from his partnership. That was a freedom number one. Freedom number two is to defer the capital gains tax for a period of time. Freedom number three is be able to be an entrepreneur with capital. We call it to go fund yourself. So he funded his own business venture with another partner too, by the way. And they built these units all tax deferred. Pretty amazing and incredible for him and his family. So does that answer the question, Julie, or did you have a follow-up one for there?
Well, when you say partner with the trust, does that mean what exactly is the definition of that? Does that mean you guys are introducing properties for them to invest in, or what does that mean?
Good question. So a lot of our entrepreneurial real estate clients already have their own deals.
Yeah.
Or they're already a hard money lender, or they already have their next business venture. We did a cryptocurrency exit for a client. She lived in San Jose, worked for a big tech company. And she had 50 million of Bitcoin when it was at 54,000 a coin. She exited 5 million into the trust, deferred about 1.85 million of tax, and used 4 of the 5 million to start a business tech startup, all tax deferred. She already had it all planned out and mapped out. We had another client who sold, I think that was a $29 million deal in Texas, a land sale. And he used a lot of the capital once in the trust to go buy some single family flips, and one is a development with part of the cash, part of the capital. The neat part is you can diversify. You don't have to put all eggs in one basket or one deal. You can be selective. You can be strategic. You can dollar cost average. Sometimes, yes, we do bring opportunities based upon the relationships that we have, where we make introductions. There's also a third-party financial advisor or financial planner, oftentimes, that we work with, who provides a financial plan based upon the client's needs and risk tolerances. And sometimes some of our clients are just putting it into the biggest companies in the world. They say, you know what? Put it into Google, Costco, Netflix, Apple, Walmart, Home Depot. I had one client out of Tucson, Arizona. He sold a $2.5 million property. And he's like, Brett, I don't ever want to touch real estate ever again. I don't even want to invest in real estate. Just put me in the biggest companies in America. And if they all fail, I'll lose my money. But in the meantime, you've helped me to defer about an extra $1 million of tax. Let's go. Right. And so that's what we did with him. So the really answer, Julie, is it's customizable.
Yeah.
And it's what the client, the note holder in this scenario, is looking to invest into.
How does it work if you are, let's say you're in an existing LLC, you own an apartment building, 200-unit apartment building, we'll call it, with partners, and you're a limited partner. You're not the general partner, you're the limited partner, and the property sells. Now, my understanding, it could be wrong, with a 1031, all the partners need to participate in the 1031, right? But how do you, if you're a partner and of a property that gets sold, you're not in control. You have to kind of, you're forced to deal with the sale. That could happen to me. I'm panic about that because I've owned a property for like 20 years that has been massive cash flow and it's been fantastic. But if they ever sell it, right? That's why I'm talking to you. See, guys, I really need Brett myself in case this happens. I'm just sharing this with you today. So what happens then? How does that work where you break apart a partnership? Can I take my portion of my proceeds and put it in there or what? Into
The
a
answer is yes. And this is one of the reasons we're Netflix versus Blockbuster, because you nailed it. In a traditional Blockbuster 1031, the whole entity must move, which typically means everybody must agree and go on, which typically means these big GP syndication deals with LPs, they don't do 1031s. Most of them don't.
right.
In fact, they just exit. Everyone just pays their tax and they all just live in Blockbuster world and they don't know it. They could have been in Netflix. And so I'll give you a deal story. We just did a $48 million exit in Las Vegas, 2 GPs and an LP. So does it work for GPs? Yes. Does it work for LPs? Yes. Does it work for LLCs? Yes. S Corps, C Corps? Yes. Yes. Individuals? Yes. It works for just about any asset you can think of: crypto, businesses, real estate, primary homes.
Primary.
1031 doesn't work for, which is really powerful.
Yeah.
It works for public or private stock. It works for carried interest, captive insurance. It works for helicopters and jets and planes and anything that's highly appreciated. Now, here's the key. It needs to be 1 million net proceeds, Julie, and a $1 million gain.
Okay.
1 million net proceeds and a $1 million gain. So if you have 50,000 and it turned into 250, are you qualified? No. If you had 250 and it turned into $1 million, do you qualify? $1,250,000? Yeah, you would, right? If
Is
you
that
have
because of fees or what?
we found that the ROI for time and energy, setup cost, ongoing fees really is only a home run or makes a ton of sense if you have that 1 million, 1 million. It's sort of like, why buy a 8 unit when you can buy an 80 unit, right? And scale the thing, right? So we want this to be a home run for you and for us. And so we've set those minimums for those reasons. However, let's imagine you have 2 assets at 500 each. You have an LP position that's 500,000, right? And you have another one that's 500,000, or one at 400, one at 600. And basically you can combine them into one trust, then you can scale it and you can qualify. So you can have one trust, 2 promissory notes. Can you add a third and a fourth and a fifth? Yeah, you can just keep adding promissory notes. And this is the cool part. You start to consolidate your equity. In fact, the deal I told you about for the $48 million deal in Vegas, they actually started out with a $20 million in Vegas. Then they did a $33 million deal in Phoenix. Sorry, they did a $16 million in Phoenix, and then they did a 33, and then they did a 48 in Vegas, and they've done others as well. And so they just keep piling up promissory notes, multiple promissory notes. You can actually go watch on YouTube David Sloan tell his whole story about the deferred sales trust on my YouTube channel. Just search Brett Swarts or Capital Gains Tax Solutions David Sloan, and he'll tell his entire story of him exiting and him getting comfortable. He's an attorney. He's a multifamily syndicator. He's really, really smart. Also skeptical and cautious, but they went through the entire process with us and they've used it at times. But the best part is the funds can go back into their own deals, right? Yeah. All tax deferred. So instead of having to raise that capital from that other LP or have to go take on debt right now that's at, 6.5%, maybe 5.5% if you're really fortunate, they're able to use the capital that is in a tax deferred state to go into their own deal.
I mean, people could invest in, if they want to take the easy route, like you said, and be super passive, they could invest in what, a syndication or a statutory trust, which you probably don't like because of fees and things like that, or I don't know what.
Well, I like it when it solves the problem for somebody. Like somebody might want to be no control, no liquidity, no diversification, and there are huge fees. I've closed those. I used to be Series 22 and 63 licensed, and so I've closed those. I've closed 1031s, of course, deferred sales trust. We work with financial advisors that still close those. So we still work with you. Now, here's the key: what problem does it solve? Well, the Delaware solves mortgage over basis issues. When you have debt over basis, we can solve that using a Delaware zero coupon deal. In fact, you can go to my YouTube channel as well. I have an entire series on this. We just did one for a $10 million mobile home park seller out of Idaho. He had debt over basis. And so we did a partial 1031 Delaware zero coupon deal.
He's going to take a loss if he were to sell? Debt over basis?
Oh, no. He was going to get hammered with tax, millions of tax. But he had what's called a debt over basis issue. So your adjusted basis, for example, is your cost plus improvements minus depreciation. His asset was selling for 5 mobile home parks for $10 million. His basis, I believe, was right around 1.5 million. Okay. His debt was about 3.5 million.
Gotcha.
He had about a $2 million debt over adjusted basis. Okay. So that difference, we had to replace that debt. And so we used a partial Delaware zero coupon deal, partial Delaware statutory trust. We're experts in how we do this. And we structured the deal where he has to put a very little amount of equity for a lot of debt replacement. And then once we solved that, we moved the rest of the funds into the deferred sales trust. So he could really achieve his freedom and flexibility with the capital that he wants to be an entrepreneur with.
Sounds awesome. You guys, it's complicated, but yet it's kind of, let's dumb it down again here a little bit, since most people listening to this probably aren't selling a $20 million property. Some people might. We've got a lot of, like you said, mobile home investors, people buying parks that are listening, apartment buildings, development, all that kind of stuff. So another dumb it down simple way, you might run into somebody, guys, that is, let's say you are looking to pick up a property because you want to do a flip, or you want to buy an apartment building or something like that, and the seller needs, in order to get that threshold to that $1 million mark, maybe they're willing to cash out and they're wanting to sell both their primary residence and their investment property, right? So that combination, you might easily, especially out here in the Pacific Northwest, get to that $1 million mark, right?
Yeah. Here's one in Palo Alto right here. This is, if you're seeing the screen, it was an $8 million deal in Palo Alto off of University Avenue. Here's one we did just south of Santa Cruz in Aptos, 7.9 million. It was a former primary home turned into an Airbnb rental, and then we helped them with that one. That was during COVID. We did a duplex in San Francisco. They lived in half of it, and the other half was rented. So we did it for that one as well. We did it for a car wash in San Diego for 13 million. Here's one that we did in a Walnut Creek area for 2.2 million. It's kind of like a old retail spot there, which was nice. So yeah, it really works for just about anything: Saratoga, Menlo Park, Cupertino, Oakland, Placerville. But at the end of the day, you got to really define what you're trying to accomplish, and then what's the strategy or technique and team to help you execute. You got to have a tax flow and a cash flow mindset. You can't just have cash. It's not just about cash flow anymore. It's about tax flow. Because guess what? The government's at all-time high spending, over 31 trillion, I think, at this point. And they're not lowering taxes anytime soon. So if you build all this time and energy and your wealth on cash flow and appreciation, but you don't have a good tax flow strategy, man, you're putting yourself in a tight spot. And you don't have a good exit plan to diversify that wealth, right? Diversify, get out of debt, get liquidity. Now's the perfect time to do that, right? Don't just hold and hope. Hope is not a plan. Make moves and strategize, and that's what we want to help you to do.
Right. So here we're kicking off 2023, and people are talking about, even you, Brett, mentioning that there could be some big opportunities here coming up. The thing is, you got to know about this for yourself, right? You're thinking, man, yeah, I want to cash in some of my properties, get to that $1 million mark or higher, and trade up. But why this is such a powerful information also is, a lot of times you can't even get access to let's say you found a property that you want to buy. You have a seller that's willing to sell. Part of the problem is they feel stuck. They don't want to sell because they don't want to take the tax hit. They don't want to be bothered with the 1031, or they just don't want to own real estate anymore. We hear about the DSTs as far as the Delaware statutory trust. I see so many people that think that's the answer because they don't know about this, right? And you can still solve that problem for people that are like, I just don't want to go buy more real estate, right? Well, what's your solution? You're either stuck, you do a traditional seller finance deal and you're tied to that asset and all that crap long term, which a lot of the older people say, I don't want to be tied to that. I don't want to be having to foreclose, just like we talked about earlier. This is the perfect solution for them, where you can add value so you can get access to the properties that you want to buy, right? So you want to trade up yourself, great, but the person that you're trading up you're buying their property, they need an exit. So now you can cover both sides of the coin, add value. What happens when you add value? People start to trust you more, you build that rapport, and there you go, right? I'm sure you've built your entire business, Brett, of your brokerage business even, or your own investment portfolio, just off talking about the deferred sales trust. Is such a good message to lead with. Lead generation. message.
Yeah, Julie got it. Joe, I think Julie's becoming a Netflix believer. You know what I mean? Do you remember like our parents that were like, nah, I don't want to do Netflix. I want a Blockbuster. I want to be able to drive and see it. Like, all right, well, eventually you might not be able to do that. But I think what do you think, Joe? Is she becoming a believer?
I think so. I
I've
think
always
she's
been a believer.
definitely all in.
We just need
Yeah, so to
somebody.
answer your question, I think we get paid to the extent that we solve problems, right? So when you know enough or more about the people that you're serving, their property, their challenges, their desires, their ambitions, and have a solution to help them either solve the problems or move to an ambition, then we get paid. Yeah. And so that helps, right? When you have something that's transformational like this, and we believe that it is the future of building wealth is this tax flow deferred sales trust strategy. But you've got to get educated. You got to jump in. You got to dive in. I say go ride the bike, because a lot of people have rode the 1031 bike, and sometimes commercial real estate people, it's like old dogs, new tricks. And I get it, because that's my world that I came from, and my parents and our family and my background. But things have changed. And the neat part is the deferred sales trust has been around for almost 27 years now. So it's not actually new. You might be hearing it, it's new to you, but here's the secret, Julie. Most brokers and most 1031 companies don't want you to know about this.
Right.
They want to keep you in the 1031 exchange loop. That's where they get paid. So be aware of that. In fact, that's why you want to work with us too, for even if you're doing a regular 1031, you want to have a backup plan. You want to get with us because we work with our strategic alliance and with us provide the 1031 service to make sure you have a backup plan just in case your deal fails. So yeah, those are all right, Julie. You're spot on. Thank you for sharing, and thank you for the encouragement.
Yeah, I mean, if you're a broker, I'm a broker. It's such a great opportunity if you come across that wants to sell and they're complaining about taxes, this and that, or capital gains. Boy, you might even get 2 deals out of it if you introduce that. If they sell at least enough to get over that threshold, you might get 2 deals out of it or more instead of just one. Such a great thing there. Well, good stuff. Good stuff, Brett. So what should they do again? Tell us how they can get in touch with you. And you work in all states, or?
Yeah, we've got team members and strategic alliances across all 50 states. And our focus is the top 5% of all luxury residential real estate agents, commercial brokers, M&A advisors, and business brokers. And then unlocking freedom for the clients using the deferred sales trust. So we've got a couple of resources for you. Of course, the YouTube channel, check that out, subscribe. We've got the masterclass, the DST masterclass every Friday at 10 a.m. Pacific Standard Time, 1 p.m. Eastern. We've got the new book coming out called Building a Tax Deferred Exit Plan. Actually, I'm changing the title. This is just if you're looking on video, it's just the proof, the draft. It's going to be called Building a Capital Gains Solutions Plan, which is exciting. We have Kevin Harrington from Shark Tank in the book. We've got some amazing commercial real estate operators and financial advisors in the book. And they say to get in room with some smarter people. So I just try to get in the book with some smarter people. I got a couple chapters too. So you can check that out on Amazon, coming in about 30 days. But all of that can be found at capitalgainstaxsolutions.com, where we also have a free ebook you can download. And we would love the opportunity to chat with you, to work with you, to connect with you. So find us there.
One thing that we didn't touch on real quick, which is a major thing we've left out, is when does this need to be set up? Like, let's say he's thinking maybe in 2 years I might want to sell. Can you do this? You decide, let's say somebody makes you an offer, you go under contract. Can you do it once you're under contract, or does it need to be done ahead of time? We forgot to cover that part.
It all depends, Julie. So to answer your question, ideally you're getting with us early. You're getting with us right now. You're developing your team, right? You're developing your plan, and you're clarifying what you're trying to accomplish. And we'll work through that, and we'll build a customized plan. Here's the cool part. We work on a conditional basis. So it's 100% no cost, no obligation. If you don't use the trust, your deal isn't closed. You don't owe us anything. Okay. And that's the cool part, the way that we work. We take that pressure off. When is it too late? Well, we know for sure it's too late if you receive the capital into your personal account. Right, you've closed on the property, you closed on the Bitcoin, you closed on the primary home, the funds are sitting in your account. Escrow's closed. It's too late. Is it too late if I'm under contract? Well, it depends. Has the buyer removed all contingencies? No, they have not. Great. We still have time.
Okay.
So, but ideally, we've done this and we've pre-planned even before you listed the property, because here's why. There's certain escrow companies that don't know what they're doing. There's brokers that don't know what they're doing. And so that's why we work and train with some of the top real estate professionals across the country who understand this, and with escrow. And that's what we do. We are brokers ourselves. This is what we do. And so we want to work with the pro, work with us, because we're happy to help you out and make sure there's no mistakes.
Awesome stuff. Well, there you go, guys. We just saved y'all your money. So you can thank Brett for that one. And we thank you for joining us today, Brett. And Joe, where can everybody find the details about today's podcast?
Yeah, guys, you can get to all the links that Brett mentioned in the description down below on YouTube, or if you're on the website, the show notes can be found at seattleinvestorsclub.com/177.
Awesome stuff. All right, everybody, have a kick-ass 2023, and we'll talk to you next time.
Bye, everybody.
Thanks for listening to the Seattle Investors Club podcast. If you have questions that you'd like to have answered on the show, shoot us an email at info@seattleinvestorsclub.com. Now go out, take that action, and build that real estate business. Thanks for listening.